Hello, with me today is Bill Ackman, manager of Pershing Square Holdings. The investment vehicle has been incredibly successful in recent years, generating a 58% return in 2019 and a further 70% in 2020, according to data from the company. Now that's helped to drive up the value of the shares and secure it a place in the FTSE 100 index at the end of last year. So Bill, can you explain the strategy of Pershing Square Holdings and what you look for in an investment?
Sure. Our strategy is to find the best businesses in the world. We call them simple, predictable, free cash flow generative, super durable growth companies, businesses that earn high returns on capital, are minimally capital intensive, don't require constant access to the capital markets in order to implement their business models, are kind of undisruptible, wide moats, sustainable competitive advantages, not exposed to extrinsic factors we can't control, like movements in commodity prices or interest rates, et cetera. So the ideal business. And of course, we want to buy it at a fair price. And because other people like to buy ideal, great companies that which have these characteristics, it's rare to find businesses like this at an attractive price. And one of the what's enabled us to do so historically is the fact that even the greatest businesses in the world go through some challenging moments. Managements and boards make strategic decisions that are not ideal. Unfortunate events occur, or investors misappraise the quality of the business, and those tend to be our targets. And I think we're quite well known for being, one, we're highly concentrated. We deploy our capital in 8, 9, 10 investments. And top 3 could be half the portfolio. So it's a very high degree of concentration. That's the focus on business quality, balance sheet strength, durability, minimizing risk of loss. Those are obviously kind of key reasons. We also tend to be the largest shareholder, and often, if not the largest non-index fund shareholder of a company. So we have a lot of influence, and we've used that influence to make changes when the changes are necessary. Management changes in boards, as well as just, most of the time we're just applauding from the sidelines and have an occasional idea of how to make a business more valuable. With the management team, one of our holdings coming in on Monday, when we're going to spend a day together just talking about the company and sharing some ideas that we have on how we can help. That's the basic idea. Long only, super high quality, durable growth companies. That's the bulk of the strategy. And then a subset of the strategy is looking for risk in markets and trying to hedge those risks. And so, the best evidence I can give is pre-financial crisis, we were concerned about what was going on in the credit markets. So we built a very large notional short position in credit by purchasing credit default swaps on the bond insurers, on Fannie Mae, Freddie Mac, on the banks. And as a result, S&P was down 52% in, I think, 2008. And I think our peak decline was 18%. It was just momentary. And we finished the year down only a few percent. And we're up 40% the next, driven by that hedging gain and the redeployment of those proceeds in buying stocks. And then last year, when we became quite concerned about the pandemic in February, we did the same thing. We thought the best way to express this concern and in a risk minimizing way is to, again, buy credit default swaps, put a very large notional position in the credit default swap market, and then spreads gap very widely as it became clear that this was going to be a pandemic. And then we reversed that position as our portfolio declined in value, our stocks went down, and our hedge became enormously valuable. So the hedge actually, on a mark-to-market basis, mitigated almost our entire mark-to-market loss. But more importantly, it gave us capital to invest, over $2 billion of capital to invest in a market that was down a large amount. And most recently, our biggest kind of black swan fear for the markets earlier this year, we became concerned about inflation. We thought inflation could lead to higher rates. We thought higher rates could lead to lower values in the equity markets. And we built, again, a very large notional position betting that rates would go higher. We did this using swaptions, which are sort of an option on an interest rate swap, which is a way to express that kind of bet. But the 3 things I mentioned they're small. The capital commitments are 1%, 1.5% of capital, numbers like this. But they can turn into very, very large numbers in the event that the sort of outlier event takes place. And so those are really the 2 prongs to the strategy. The latter prong is episodic. You can't guarantee we're going to be able to hedge every extrinsic black swan risk and that we're going to be there in advance, but it's something we think about, and it's been a meaningful contributor over time.
What else? Which other stocks in your portfolio have been doing quite well, or is there anything that is perhaps disappointing you at the moment?
I'm really not disappointed by anything. That doesn't mean we don't have one position that's down a lot. Our smallest position in Fannie Mae and Freddie Mac. This is, I should have said, our core holdings tend to be 10, 15% positions in these super durable growth companies. And then we've got a small place in the portfolio, what I call mispriced probabilistic investments. You can put the CDS investments in that category. You also can put Fannie Mae and Freddie Mac in that category. They represent about 1.5% of the portfolio. And these are businesses that meet our criteria for business quality. This is what supports the housing finance system in the United States is Fannie Mae and Freddie Mac. It's like owning a royalty on mortgage finance in the US. It's a great business. It's an oligopolistic business. But in the financial crisis, these businesses we were actually short the credits of these companies. They were taken over, put into conservatorship by the US government. And they were supposed to recapitalize and merge. And they have not been allowed to recapitalize, even though the businesses have done extremely well. The government's continued to extract billions and billions, literally a couple $100 billion of dividends out of the company. That finally stopped right at the tail end of the Trump administration. And our expectation is they will eventually come public again. They are publicly traded, but they'll be released from conservatorship to become true public companies. And that happens when they become recapitalized. It will take several years of retained earnings for them to be recapitalized, and will take some kind of legislative action and or regulatory steps for that to happen. But we think the stocks are worth 20-fold, 30-fold where they trade in that event. But they were down this year because people had some hope, shareholders had some hope about a case that made its way to the Supreme Court, where some shareholders had sued with respect to whether there had been violation of law when the government took the various steps it took. And that case was resoundingly defeated in the Supreme Court, and that led to the stock sell-off. But pretty much everything else we own, have done quite well this year. You work your way through the list. Hilton stock's been a very strong performer. I could look up the relative performance. Hilton, Chipotle, Lowe's, even Howard Hughes. Our investments have done quite well. We exited a position in Agilent, more than doubled in the last relatively short period of time. And then our holdings in Domino's Pizza, that was a new investment. We sold our stake in Starbucks, a double in the last year, and replaced it with a new stake in Domino's we acquired in the mid 300s. The stock is in the high 400s. The only thing that's offset our returns this year at all is some loss in Fannie and Freddie. And then I should mention actually our biggest disappointment this year, which I shouldn't fail to mention, is that we launched a SPAC a little over a year ago called Pershing Square Holdings. And the SPAC was supposed to acquire Universal Music, and we were excited to create that transaction for the SPAC shareholders. Unfortunately, the SEC would not approve the structure of that transaction, and we're back to the drawing board for the SPAC. In the SPAC, we mark to market, or required to mark to market, the sponsor warrants we hold and some other instruments we hold in the SPAC, which are more like derivatives. And they were up a lot at the end of last year as people got excited about SPACs, and they lost value this year because as people got disappointed about SPACs and as that transaction was not able to close. So those were the two biggest negative contributors. We're still having a strong year. We're up about 18% or so, 17, 18% year to date in PSH.
Well, Bill Ackman from Pershing Square Holdings, thank you very much for joining me.
Appreciate the time. Thank you.